Do you enjoy overpaying your tax bill by 5 to 6 figures every year? Does it make you feel good leaving the government a tip for all the hard work they do during the year? Do you enjoy working half the year for free in order to make sure the government gets 50% of your income? Didn't think so. Well, I have good news. I'm about to share with you the exact tax saving strategies I give to my clients in order to save them $10,000 to over $100,000 per year on their tax bill. If you're a business owner, you've probably heard that S-Corps are a good way to pay less taxes. But turning your business into an S-Corp alone does not save you any money in taxes. In fact, if you don't have an optimal tax strategy, an S-Corp could lead you to paying more in taxes. And 95% of CPAs don't actually tell their clients where they go wrong. This could either be because they're too busy, or maybe they don't actually even know the strategies, or maybe they just don't care what you pay in taxes. This leads to business owners like you overpaying on your taxes every single year. But I'll give you these strategies for free. Without diving into all the boring details, let me first briefly explain what an S-Corp actually is. An S-Corp is a very inflexible business entity that should be used as the final barrier between you or your trust and the business activities that you're actively involved in. Don't plan on opening a new S-Corp for every new business idea that you have. Don't put a bunch of your property vehicles or investments into your S-Corp and think it's going to save you a bunch of money in taxes. Don't open up an S-Corp on a business where you're going to raise money to actually fund your business idea. I can go on about the traps and downsides of an S-Corp in another video, but just know that it's not a one-size-fits-all strategy and does require you to either be very organized and knowledgeable on tax law or have an accountant who will be organized for you. So let's actually talk about how exactly you can maximize your tax savings with an S-Corp and save 5 to 6 figures annually on your tax bill. Number one, paying less in Social Security and Medicare taxes. A common theme you're going to hear with all these S-Corp tax benefits is that they're directly impacted by how much salary you pay yourself. And the savings that come from your Social Security and Medicare taxes are no different. The IRS requires you, as the shareholder of your S-Corp, to compensate yourself with the regular W-2 salary in return for the services that you provide to your corporation. In short, the less salary you pay yourself, the less in Social Security and Medicare taxes you'll pay. Now, what's considered reasonable is a massive gray area. And if the IRS finds the salary you went with to be unreasonable, or if you didn't pay yourself a salary at all, they have the authority to reclassify all the money you took from the business as your salary and demand payroll taxes as well as late penalties and interest on that full amount. So the answer to the question you've probably been wondering, how much salary is reasonable? Probably it's enough to avoid problems with the IRS. And realistically, they're only going after the very low-hanging fruit for them, which is people who made a bunch of money but didn't pay themselves any salary. So what exactly are the savings here? Well, for every additional dollar of salary you pay yourself, up to $176,000, you'll have to tack on 15.3% in taxes, plus whatever your state requires you to pay, which could be any or all of unemployment insurance, disability insurance, paid family leave, etc. Now, half those taxes will be a business expense that will lower your income tax, so it's not a complete loss. But additionally, you'll face a 0.9% Obamacare tax if you pay yourself above $200,000 single or $250,000 if you're married. So does that mean you should automatically pay yourself the lowest possible amount? No. Sometimes paying yourself too small of a salary can lead you to paying more in taxes, which leads us to our next tax strategy. Number two, maximizing the qualified business income deduction. This might be the single greatest tax benefit of all time for business owners, and Trump just made it permanent with the passing of the new big beautiful bill. Why is this so great? Because as long as you meet some very basic hurdles, you can get a 20% deduction on all your business income for doing nothing. So what do you need to know? Well, in short, you'll only lose out on the qualified business income deduction if you don't have enough W-2 wages paid by your business. If you already have a few full-time employees, great, you're probably already there. But this day and age, there's a lot of solopreneurs, lean teams, and businesses that run on contractors out there, and they are all at risk of losing out on this deduction permanently. You see, if your income is over about $220,000 single, $430,000 married filing jointly, that 20% deduction against your business income needs to be greater or equal to 50% of the W-2 wages your business pays. Sounds complicated, but here's a simple rule of thumb you can follow. Take your bottom line profit before paying yourself, multiply it by 2/7. Pay yourself exactly that. Say your business's net profit before paying yourself a salary is $1 million. You want to pay yourself as a W-2 salary exactly $285,714, or 1 million times 2/7. That'd mean after paying yourself, the business profited $714,286. So you should get a 20% deduction worth $142,857. The only way you'd qualify for that $142,800 deduction is if the business had double that total in W-2 wages paid. Well, that happens to be exactly what you paid yourself. If you pay yourself any more than that, you're paying thousands in extra payroll taxes and are losing out on more of the qualified business income deduction because now there is less profit to base a 20% on. If you pay yourself any less than that, you're losing out on the remaining qualified business income deduction that you should be getting. In order to hit the sweet spot, you need timely and accurate numbers so you know exactly how much the business is making. One disclaimer, if you're a specified service, trade, or business, you could miss out on the entire deduction just because you are that type of business. A lawyer, doctor, accountant, unfortunately, there's rules that exclude those deductions over a certain income level for specified service, trade, or businesses. Next is a tax strategist that knows what they're doing. Being over or under the sweet spot leads to you paying thousands, if not tens of thousands more in taxes, and it's completely avoidable. Let's say you aren't at risk of losing out on this deduction. In that case, it probably makes sense to pay yourself as little as you reasonably can. The more profit that's left in the business compared to on your W-2 will lead to a greater qualified business income deduction and less payroll taxes. Now let's talk about the next strategy. 3, maximizing your pass-through entity tax election. What's the pass-through entity tax election? Well, usually, S-Corps don't pay taxes. The income passes through to your tax return as the owner, and you pay the taxes personally. The pass-through entity tax election is an optional election you can make to shift your state income taxes that you would have already been paying to your business. Then you simply get a tax credit to where you don't have to pay these taxes again on your personal tax return. And why would you do that? Well, it creates an additional business expense that you can write off. That tax is based on your business's bottom line net profit, and the amount depends on your state. Say you net $500,000 with your S-Corp in California. At a rate of 9.3%, you could shift $46,500 worth of California taxes that you'd already be paying anyways to your business. And that'll create a $46,500 write-off without paying any additional taxes. This is another deduction that is heavily impacted by how much you pay yourself. Because the more you pay yourself as a salary, the less profit the business will show, meaning you get to deduct less pass-through taxes. And another thing to consider is that the more pass-through entity taxes you write off, you get less of a qualified business income deduction. All these strategies are very interrelated and cannot be taken out of context. You need to work with a CPA that's actually going to help you sort through all these numbers and optimize your tax strategy. How do you know if you should be making this election? If your business is an S-Corp or partnership and you are even somewhat profitable, chances are you should make this election. With the passing of the most recent tax bill, you can deduct $40,000 of your personal state and local taxes on your personal tax return. But keep in mind, you already get a standard deduction of $15,000 if you're single and $30,000 if you're married. That means you don't actually need to write your taxes off to get that standard deduction amount, but you can double dip and take the standard deduction on your personal tax return while also writing off your business state taxes on your business tax return. There's a ton more factors to consider with S-Corps. Like I mentioned earlier, it's not a one-size-fits-all strategy. But ask yourself, why has your CPA not gone through all 3 of these basic tax strategies with you to help you pay as little as possible in tax savings? If you want to work with a CPA firm that is actually going to save you money on taxes, book a call on my calendar in the description.